I'm gonna start the recording. All right, it's 12:01, so let's go ahead and get started, everyone. Good afternoon and welcome to the Sage Investor webinar. My name is Jen and I'm a co-founder of the Sage Investing Group along with my partners Maggie and Lana. Thank you so much for joining us today. If a question pops up during the course of the presentation, please throw it into the chat box and we will get to them before we wrap up the webinar at the end. So you will often hear from real estate syndicators what makes their deal so amazing, but you often don't hear as much about the risks that are associated with those deals unless you dig further, right? We get it. It's a very daunting topic to cover graciously, but it is nonetheless a very important topic. And as former auditors for more than a decade, you can say that we made a career uncovering and addressing risks in our respective industries. What we have seen is that those who have thoughtfully considered number one, the potential risk inherent in any investment, and real estate is no exception. And number two, that they've considered its impact and its likelihood, were actually better equipped and better equipped to respond to any setbacks or downturns in their particular business or investments. And we, as former auditors, we love this because as an optimist at heart, but pessimist in the brain, we opt to expect for the worst, but we prepare for it and we hope for the best. So of course, none of this is really a perfect science, okay? There are no absolutes, but careful planning and understanding certainly helps you at least be more aware of risk possibilities. And having that knowledge is half the battle. So we're gonna spend some time today sharing with you guys the top risks that are inherent in real estate syndications so that you have the tools, the knowledge of what the risks that lie within real estate syndications are, and that you are better equipped to ask the right questions or have at least a better understanding to make an informed decision for yourself when placing capital in private real estate investments. Now, before we dive into this riveting subject, I want to make a little introduction about the Sage Investing Group. All three of us, we have a Big Four accounting background, which means that our background is rooted in audit and risk management. Sadly, auditors are typically not most people's favorite professionals, unless we're on your side. And because no one really wants to be audited, I mean, we're very detailed. We ask a lot of questions and we never really believe anything that anyone says unless we see the evidence, right? So although not very popular, we do see a lot of benefit and value in what we do and how it can help others in the multifamily investing space. So now, using our combined 35 years of professional experience in audit, accounting, and finance, along with our real estate investing experience and thousands of hours underwriting multifamily deals, to what we do now in multifamily syndications. That is, we critically vet the deals so that busy professionals like you can invest with greater confidence in these syndications. Today, our group, we have over 240 members in our community and over 520 Facebook followers. And collectively, we have participated in 15 deals, totaling over 4,500 multifamily units with a portfolio value of more than $497 million. We just added a 354 unit investment to our portfolio just last week. So we're very excited about that. So evidently, based on the size of the portfolio, we truly believe that multifamily is one of the best asset classes out there to invest in. We've created this webinar series to provide educational content so that you can decide for yourself if this is the right investment strategy for you as well. So this webinar is really for anyone who has ever tried to invest in syndications before, but end up backing out, invested in syndications before, but didn't feel like you know enough, or you just feel overwhelmed by all the information that's out there. Well, this is a really great place to learn and to continue building upon your knowledge so that you're more prepared when the next opportunity does come up. Now, before we dive in, one more little thing, we have to say this little disclaimer. This webinar is for your education only. Although we all have a CPA background, Sage is not a legal, financial, or tax advisory firm. So please consult with those respective professionals for those legal, financial, or tax-related questions. And please note that we cannot guarantee any returns. And of course, there are risks associated with any investments, and that's what we're going to talk about today. And with that, we hope after today's webinar, you'll walk away with the understanding of what the risks are for investors in an apartment syndication. Number two, why is it important to know and understand these risks? And thirdly, how do you protect your capital now that you know what these risks are? And by the way, where are these risks outlined anyways? Well, believe it or not, most of them are already outlined in the private placement memorandum, or the PPM. You know, that long, sometimes dry legal document you have to read and sign before investing in any private real estate deal. So yeah, it's very legal speak, and it can be difficult to understand, but it's definitely worth taking your time reading through it. And after a few reads, even over several deals, you'll probably get more familiar with it. And dare we say, probably get more comfortable with that legal speak. So while you get yourself there, there are actually really two key risks, in our opinion, that it all kind of boils down to. And we'll share those with you in a number of ways that investors can mitigate these risks for themselves and protect their hard-earned money, and also a few mitigants we at Sage like to employ as well. So let's get started. Lana?
Thanks, Jen. Okay, so the first one is probably the biggest, and that's risk of losing your investment. So as a limited partner, the good news is your risk is exactly that, limited, meaning it's limited to the amount of money you've invested in a deal. But this is still a very real risk that you'd be exposed to. You can lose all of your invested amount. So if you're investing with your last 50 or 75K, I would say probably not a good idea to do it. You know, save that money for life unexpected turn of events that may come up, and keep that in your emergency reserves. Investing in private real estate deals should really be done with extra capital that you would be okay walking away from. And this is as your worst case scenario. So that, you know, mentally and financially, you're more prepared for investing in these type of deals. So now that I scared you enough with this worst case scenario, let's talk about what the likelihood you would lose it all. Probably small. So why is that? Well, if you think about it, you're investing in a hard asset. It's tangible. You can see the property that has value. It sits on a piece of land that has value. So what's the likelihood that all that value, that property, that land, and yeah, maybe even the people living on that property, all of that just disappear? It's pretty remote. So this is why real estate investments have been for quite some time one of the better risk-adjusted assets out there. The asset doesn't just become obsolete because it's still housing at the end of the day. It's one of the necessities to living. Even if a shinier, newer, new building comes out, there are still going to be people who are going to need a roof over their heads. Now, could you command the same rent as that shinier new building? Maybe not, but then again, do you lose everything because of that new asset? Not likely. The second risk, you know, while it's not as dramatic as the first, it's still a real risk to contend with. And that's the risk that the investment doesn't meet the projected returns. And this can appear in different ways. maybe the deal doesn't hit the exit price that it was initially targeted. Or maybe the market softens and in year 5 or 6, or however long the deal was intended to be held for, isn't actually the best time to exit or sell. It's possible that the deal continues on for longer than was anticipated. And remember, this isn't a liquid investment. It's very much a long-term investment play. Or maybe the time it takes to complete renovations, especially if it's a value add investment strategy, is just going to take longer than it's anticipated. And if you've ever seen or attempted to do a home renovation, say to your kitchen or bath, and you're working with contractors, you probably know that those timelines or plans can sometimes derail. It's just going to take longer to complete the business plan. And when this happens, it's also very likely that it's going to extend the time it takes to hit those projected pro forma revenues. And that's going to impact those returns that were projected at the onset of the deal presentation when you would have invested. Or maybe the property is performing, but the distributions to investors are not happening or they're getting delayed. Or even if they are getting distributed on time, they're lower than the amounts that you had projected because it's possible that the property has some unforeseen cash needs to maintain operations. And needing that cash on hand, and it's needing that cash on hand to meet debt obligations or payments to vendors for services that they rendered at the property. Now, these may be to a lesser degree, maybe a lesser degree of a risk than, say, losing your entire investment amount, which was our risk number one. But the likelihood of these events occurring is probably less remote than our first risk, meaning, yes, it's possible your investment returns fall short of expectations for a number of reasons, some of which we just shared. Now, we covered the two most obvious risks, which is the potential for losing your entire invested capital, or even if you don't lose it per se, but getting returns that fall short of expectations. What's not so obvious a risk, where there is something called capital call, the potential for a capital call. This is where investors haven't quite lost their entire investment in, say, risk scenario number one, but the deal is in very much need of additional capital infusion to keep the deal going. And hence, the additional capital is called from investors. The existing investors have the right to refuse adding more capital into the deal, of course, but then this also means that your ownership share becomes diluted just by virtue of other investors who are in the deal putting in more capital. Or even if, say, the existing investors don't put in more capital, the deal sponsors may open the deal up to new investors or LPs, which just cause each existing investor's share of the pie to become smaller. So, if you're still with me, even after I just shared with you the many reasons why you may not want to invest in private real estate deals, kudos to you, or it wasn't scary enough. But so the question here is, after all that, why would one, us not excluded, would ever want to invest in given all these risks? Well, it's because many of the risks that I've shared, there are mitigating factors that help lessen the impact or likelihood of the risk potentially materializing. Of course, there's no absolutes in life, but these mitigants help put into perspective all of the what could go wrong in my investment with what could be done about it. So Maggie's going to share with us some of the things we like to do for the deals we invested, and that we also open up to our investors to invest alongside with us. So you can get a better grasp of how it is that we, as risk-averse auditors, get ourselves comfortable investing in these private real estate deals. Maggie?
Thanks, Lana. Now that she scared you enough, let's talk about the mitigant to the risk that Lana shared. So number one, you want to invest with an experienced team. So investing with an experienced team is always a good mitigant to any investment. So seek out experienced, reputable, and quality operators to partner with on every deal. They must have the experience and track record to execute the business plan for the assets that you are investing in. And for a good measure, at Sage, we also perform a third-party background check and also a reference check on key members of the GP team who we partner with on behalf of investors. This is the most important mitigant because at the end of the day, you are investing in the people to look after your investment. So we cannot emphasize this enough, this point. Number two, you want to diversify among growing markets. And to mitigate the risk of loss, diversification is the key. It is true in stocks and it is true in real estate as well. So remember to diversify your investment offering among different markets that show a positive trend. In the event of a recession, each market, if you will be impacted in different ways. So whether it's a primary or tertiary market, we like to look for markets that are fundamentally strong and showing a positive growth trend. For example, we like to see, of course, a good population growth, income growth, home value growing, and there's a diverse employer base with no concentration of particular employer or industry. And a good pulse check that we like to see in the market is that we like to do an analysis, just a quick check, analyze the unemployment rate of a market and compare it to the state and the national level and look at it since the last Great Recession to date and see if your market is doing better or worse than the state or the national level. If it's doing something better, then you know there is something underlying in the market ecosystem that is supporting it and growing it and further positive trends. So third, conservative underwriting. You want to check if the deal is underwritten conservatively. And there's a lot we can cover in this topic. A few easy key things that you can look out for is one, is the operator assuming the market condition will be worse in the future than it is today? And so you want to check, is their exit cap rate should always be higher than the entry cap rate. In other words, this is a way that the cap rate is the way that deal is valuated. So if it's higher at the exit cap rate, exit rate, then they're valuing at a lower valuation at exit. Number two, on rent increases for conservative underwriting, you want to see how rent assumption compares to similar comparable markets properties in the market. And this is an easy check. You can go on apartments.com. That's a good way to kind of check if your property, how is your property compared to comparable properties, even if you're doing a value add project. You want to see if there is some wiggle room between that your assumption. It was typically we like to see about $50 gap between your property and the property that you're trying to mirror. Third, if the value add investment, if you want to see that if all the capital, if it's a value add investment, you want to see if all the capital is raised up front. So this way, it's not dependent on the property cash flow to support its renovation. You also want to see if there is contingency funds that can be tapped into for any one-off surprises that may pop up during the course of the whole period. And this will further minimize the chance of capital call. And as mentioned, there is so much that you can get into in conservative underwriting. We'll share later a previous webinar that we do that touch upon more on this topic. Number four, asset. You want to invest in an asset that cash flow from day one. The best, we recommend investing in these assets that's cash flow on day one. This helps mitigate the risk that if a business plan doesn't take off flawlessly, and you know that happens something always pops up. And there's something, so you want some breathing room as the asset is able to sustain itself from the beginning and cover its all expenses and debt obligation. Last, you want to invest for cash. The best source of fund to invest is, of course, is extra cash that you don't need, as Lana mentioned, to live off or now or during an emergency. This is a cash that is sitting around that you have the privilege to deploy, and you can bear the complete loss of should their worst case scenario arises. We do advise our investor that before you invest, always make sure that you have the reserve account and don't invest until you have enough funds saved up. So what if the emergency comes up, and you do need to pull it out in tough time and you need your money back? Well, worst come to worst, depending on the operator, you may be able to get your money back before the property is liquidated. As these are private investment, there is no open market to sell your shares if you need to exit. There may be another investor who may be willing to buy you out, and there are some legal fees involved. The returns will thus depend on how the property is performing at that particular point in time. So it's not completely impossible to get your money back if you need it in emergency, but should be the last resort you should take. So now that, so to learn more about how you can actually vet and most three critical factors in investment, the team, the market, and the deal, you can access a previous webinar through our YouTube channel. And here are two relevant topics we covered in the past that goes in deeper in these factors. And you can get a better understanding how to evaluate and consider your future potential deals. And these are how a sage investor can quickly vet a deal in 10 minutes or less, and how a sage investor can vet and operate in the market. With that, I'm going to pass it back to Jen.
Thank you so much, Maggie. So I didn't include the link to our YouTube channel on that slide. However, we're going to send you a replay of this presentation after the webinar. And so when you access that replay, you should be able to see our other webinars on there as well. And if you can't find it, just email me or at info@sageinvestinggroup.com and I can give you that link directly. So with that, we are now open to any questions that you may have. Feel free to put them in the chat box and we will get to them. And while we wait for these questions to filter in, if you found this webinar to be helpful and you know of someone, a friend or family who might also be interested in learning more about multifamily investing, we'd be happy to love those that you care about. And if anyone here is not a part of our Sage investing group yet, or if you want to refer your friends or family to join, you can visit our website at www.sageinvestinggroup.com. And you simply need to click on the Join Now button, fill out a questionnaire, and most importantly, set up a call with us so that we can get to know you better and see if what we have to offer is a good fit for your investing strategy. So with that, we can get back to the questions. Does anyone have any questions? We can give you a few moments to think about it. But if not, that is completely fine. That means we did a great job today. And always feel free to email us, get in touch with any of us if any question does pop up about this topic, and we'd be happy to talk you through it. All right, I don't see any questions coming through. So that's fine. Thank you so much, guys, for attending the webinar today. We certainly enjoy talking about this topic with you and just sharing ways that you can look out for yourself and protect your capital, which is our #1 priority as well. So hopefully we'll see you again on the next webinar. Have a great rest of the day and we'll talk to you later. Bye. Thank you, everyone.